Hey, it's Jaime with Echo Real Estate Advisors. Welcome back to my channel. If you're a home buyer, a home seller, an investor, or simply want to learn more about real estate, this is the home for you. So don't forget to subscribe. Okay, we're covering a very fun topic, mortgage payments. Not so much, right? Mortgage payments are not all that fun. I'll give you that. However, they're super important. Whether you're a homeowner, you're experiencing them now, or a renter that's going to become a homeowner, it's very important that you understand what a mortgage payment is, as that's going to affect your next 15, 20, 30 years. So you want to have a good understanding of what a typical mortgage payment is comprised of. First, let's talk about what's a mortgage payment. Whenever you purchase a home, you can either purchase that home all cash. Essentially, if you have the money in the bank, you're going to go to the bank, take all that money out, and purchase the property. That's one way of buying a house. Another way of buying the house is what's called owner financing. So whoever the owner of the property is, if they are willing to finance the sale of the property, in other words, you give them a down payment and then you make them a monthly payment, and ultimately you're paying off the house, that would be owner financing. It's a way of financing the purchase of a property. That's the second way of buying a house. The third way of buying the house is what we're going to cover today, which is a lender mortgage payment. So when you go to a lender, you go to a bank, you get somebody else to help you out with the home. So the property owner is going to be getting the entire lump sum of what they're asking for that. They're going to get it in a lump sum. Some of it's going to be from you with that down payment that you made, and some of it's going to be from the bank. So for the owner, it really doesn't matter if it's your cash or the lender's cash. But for you, you're financing yourself. So that is where the mortgage payment comes in. It's another way of saying repaying your loan. And when you're repaying your loan, you're making those monthly payments. Typically, it's a 15-year loan, 20-year loan, or a 30-year loan at a typically fixed interest rate. So we're going to get into that here in a little bit, but that is, for all intents and purposes, what a mortgage payment is. You're paying for your loan. Now, let's break open what's in that mortgage payment. There's 4 items to consider. And the fourth one, I'm going to park it for a little bit and really elaborate on the importance of it, because you need to have that understanding. The first part is your principal. So the principal of the loan is the amount of money that you borrowed from your lender. So if the property is $300,000 and you have $50,000 as down payment, the remainder of the $250,000 will need to come from somewhere, and that would be coming from your lender. So your mortgage, your principal, is going to be $250,000. That's the amount that you owe. Now, the second part of that mortgage payment is the interest. The bank or the lender is nice, but they're not that nice. They expect a return on their money. So that's where the interest part of the loan comes into play. So you have the principal, which is the amount that you borrowed, and 2, the interest, which is the amount that the bank is charging you or the lender is charging you to give you that loan. Now, the third part of the mortgage payment is where I'm going to start slowing things down a little bit, because now in this environment, we're in 2019, your principal is, for all intents and purposes, is going to stay the same or in a consistently going down. The interest, same thing. The amount that you're paying in interest will start gradually decreasing. You have a table that is to you at closing of what every single month you're going to be able to account for, like clockwork, how much is left on your loan, what the interest is, of that nature. So it's very it's consistent. in our financial crisis back in the 2000s, that early 2000s, that was not the case. There was different types of loans. You weren't talking about a fixed interest. You were talking about adjustable rate mortgages. So ARMs is what they were called. So now the first two items, the principal and the interest, those are static generally, unless you get a different financial product, a different loan. Those are static. The third item is susceptible to change on the increasing side. So that is the home insurance portion. So the home insurance part, that is something that you are a majority of time paying into monthly. And then at the end of the year, the mortgage company, whoever's servicing the loan, will be responsible for purchasing your home insurance. So you're paying it in escrow. Now, that is what happens a majority of the time. You can certainly pay it independent of the mortgage payment, but for a majority of the loans, they are already part of your monthly payment. Just makes it a little bit easier on you, so you don't have to account for that and purchase a $1,500 policy, $2,000, they just increase depending on the value of the property, but it's a big ticket item that you, unless you're very financially disciplined, you may not have the funds to purchase whenever you need to. So that third item, the home insurance part, that is susceptible to change because premiums change. The cost for that home insurance will increase because the age of the home is certainly not getting any younger, just like us. So the roof is going to get older, the appliances are going to get older. There's a lot of things that can start going wrong with age. So with that being said, that third part of that mortgage payment is going to increase a majority of the time. Now, the fourth component of a mortgage payment is the property taxes. And this is where I'm going to park it and then make a public service announcement. So the property taxes generally are paid in tandem with your mortgage payment. You can pay it independently, but then you're responsible for a lump sum, and depending on the value of your home and depending on the rate of the property taxes in your area, you're looking at several $1,000s all at once. So a majority of the loans that are serviced, a majority of homeowners opt to pay their property taxes in escrow, meaning in their monthly mortgage payment, so they don't have to account for that in a lump sum at some point throughout the year. So in the monthly payments, you're looking at that fourth item. So let's recap. You have the principal, you have the interest, you have the home insurance, and then you have the property taxes. The property taxes, as I mentioned, this is where I want to park it for a quick second, because in the environment that we're in the year 2019, we've been on an incredible run economically and just in so many different ways. It's just such a good market. It's been continually increasing. Real estate is cyclical. At some point, there will be a correction. There's going to be a slowdown. There's going to be a correction, then it's going to come back up. It's cyclical. So what does that mean? When you purchase a property in a bull market, then next year, chances are your property is going to be more. It's going to be valued more. There's going to be more value in that property, which is fantastic. It's fantastic for you. It's a sound investment. It's an investment that you made with that expectation. However, with that expectation, the reality is property taxes, the assessed value on the property that you purchased this year, will be increasing next year. So let's give a real life example. In 2018, the property that you purchased for $250,000, you pay $250,000, but chances are that property is assessed or being taxed at somewhere around $200,000, $225,000. It's very realistic. So you're looking at a property that was taxed at a $200,000 rate. Well, the math is very simple. Your property taxes will probably be between 2.5 and 3%. I'm speaking to the DFW market. I'm speaking here in Texas. So your property taxes in other states are actually less, and in some other states they're actually more. But here in Texas, the rates, that is a realistic rate that you can expect here in the DFW area. And I can't speak to the other areas, but the formula is still the same. The assessed value times the property tax rate. Now, when you multiply those two together, if your property is being assessed at, the property value is being assessed at $200,000, you just multiply that times, let's say, 3%, and then you come out with the taxes that you owe. Now, this is why I'm making it such a big deal on that fourth item of that mortgage payment. That was last year. This year, chances are, considering that the market is still so hot, this year, chances are that the property assessed value is going to increase. So while before you were paying at an assessed value of $200,000, it's not unrealistic to think that it has increased. The property value that is assessed to your property is $225,000. So that difference of $25,000, multiply that by the 3%, that's the additional amount that you pay in taxes. So know that the first two items to that mortgage payment, the principal and the interest, for all intents and purposes, will be static. The home insurance will be increasing, but slightly. You're not going to see a huge jump. You will see a jump every other year, but you're not going to see a huge jump. It's not going to amount to thousands of dollars of an increase. But that fourth item, the property tax side of things, then you are looking at a sizable jump in areas and in markets that are increasing in value drastically. Okay, having said that, you may be thinking at this point, Jaime, well, you're probably the worst realtor in the world because you're making every single possible case not to purchase the home because you're sharing that this property taxes are just going to be so high and at some point you're not going to be able to afford them. No, don't mishear me. I want you to purchase a home because it is a sound investment. It's a great investment as real estate just continues to just grow. Yes, it is cyclical, but at some point in time, real estate, they're not making anymore. They're not making any more land. So it's going to, with time, continue to increase in value. But the reason I parked on that fourth item is to raise awareness that property taxes are real. But here is my public service announcement. Going back to that example of you purchased last year, you purchased it at $250,000 when it was assessed at $200,000. Those values are different, okay? So when you purchase at $200,000 and you get that notice in the mail, typically around March or so, of what the new property assessed value is, going back to that example of it rising to $225,000, not all hope is lost. You can actually contest the assessed value that the county is giving to your property. So if your assessed value was $200,000 when you purchased, and now this year you're being told that the property is worth $225,000, in reality it is, and then some. However, whatever is pegged to that assessed value is what you are paying in taxes, so it is to your benefit that it is as little as possible so you don't have to pay out of pocket all of those property taxes. And you can contest that. Every single person that owns real estate can contest that property tax. That assessed value is the number that can reduce. You're not going to have an impact on the rate, that 2.5 to 3%, but you can certainly have a say on what that property assessed value is on your home. or your rental home. So I tell everybody that I work with, contest. Contest, contest, contest. Even if you lose this year, go back up to bat next year and contest again. Well, that's it, folks. Thanks for watching. Make yourself at home by sharing your opinion in the comment section down below, checking out some of my other videos, and subscribing for more valuable real estate content. If there's any way I can help you now or in the future, you know where to find me. Cheers.